Okay, when you start your business, hip hip hooray, and you file your taxes and you do not have an S Corp, this means you're being taxed as a sole proprietorship, you're going to be subject to two types of taxes. One is called a federal tax, and the second one is called self-employment tax. Now, your federal tax is generally just like your tax bracket. So let's say that's 20%, and your net income is $100,000. So in federal tax, you're going to pay $20,000, and self-employment tax, you're going to pay $15,300. So as a sole proprietorship with no S Corp, your total tax is going to be $35,300. Now, when you're paying all of that money, let's talk about where it really goes, all right now? So the federal tax is going to help pay for things like the military, like raw, our military. That is what federal taxes does. Now, self-employment tax is going to help all our grandmas and grandpas out there, like with their canes, because this is going to help pay for retirement benefits, like their health insurance. That is what self-employment taxes does. So when you go S Corp, the number one thing that happens is you stop funding the self-employment tax or the grandma tax. You are no longer paying into that. So when you go S Corp, you can essentially think about, hey, my self-employment tax is gone. So in this situation, you would only be paying $20,000 instead of $35,000, because that is what an S Corp does. It eliminates you funding into the self-employment tax program. But when you do that, someone kind of gets kind of angry, right? So here's the IRS. They're like, oh my gosh, that is not fair. You go S Corp and you completely get rid of your self-employment tax. How are we gonna take care of grandma? So they're sitting there thinking, you guys come up with a deal. And this deal is now law to do something called run a reasonable compensation. So you come back to the IRS, it's like, all right, cool. How about I pay a little bit, but I don't want to pay the whole thing. So what happens and what you're required to do is run a payroll or a W-2, because when you do this, every time you run payroll, you're paying that 15.3%. Every single time that you run payroll. Generally, the strategy here is let's make our payroll as low as possible. The legal term is let's make our payroll or our compensation reasonable. So let's say we are doing $100,000 in net income. We may choose to run a reasonable salary of $30,000. So in this example, you're still paying that 15.3%. Like, you're still helping grandma out. But instead of paying 15.3% on the $100,000, you're only paying 15.3% on the amount that you choose to run as payroll, which is $30,000. Now, the last thing to consider is that S Corp is not for everybody. And S Corp is like going from a Toyota to a Lamborghini. It is a much nicer tax vehicle, but generally it comes with more maintenance, more monthly costs. And on average, it could be maybe $6,000 a year to maintain your S Corp. Whereas if you're not an S Corp, I don't know, it could cost you $700 a year to maintain that. So you want to make sure your savings when you're going S Corp is more than the cost itself. If you are a small business owner or a content creator that needs professional tax help, head to the link in my bio to become a client. My name is Duke, and I make taxes very easy to understand. Give me a follow to stay educated.